lecture today is on government's role and government failure. So we're going to talk about how government's power is to coerce can be economically beneficial, and talk about some of the difficulties associated with managing and directing the government. And then we'll go through government failure and explain what happens. So government's right to coerce. Government has a legal right to enforce involuntary transactions. So force can increase economic efficiency, correcting for market failures as positive and negative externalities, and then reducing private sector economic risks. So the problem of directing and managing government: no invisible hand, massive size and scope, the need for bureaucracy, the need for paperwork and inflexibility, the information aggregation problem, the lack of accountability. So problem with government is they have so much money to work with and manage and use for spending that there's a lot of corruption, because they can give contracts to their friends, which happened in the US with Dick Cheney, the vice president. So they can give contracts to their friends like Halliburton. And that's a problem with government. And then there's a lot of there can be bribes and kickbacks that happen. They're usually cash bribes. That's usually what happens. So that's a big part of it too. And then government failure refers to inefficient outcomes caused by shortcomings in the public sector. So governments can put their interests ahead of voter interests. That happens a lot. And put the interests of minority of voters ahead of those of majority of voters. So they could be focused on, let's say, population that votes for them. A certain party might be focused on helping, let's say, a certain group that gets them elected, and they don't help anybody else. So that does happen. There are rich people, let's say. So a party could be helping rich people because the rich people got them elected and not help anybody else. That happens a lot. Rich people or any other group. And then voting problems, principal agent problems. So the interests of agents can differ those from the principals. The principal would be the voters, and the agent would be the government. So the interests of the government could be different than the voter. And then a small group obtains large gains at the expense of a much larger group who individually suffer smaller losses. So the rich has large gains from the poor. So the poor don't make a lot of money, but the rich kind of take from them in terms of exploitation. And then rent-seeking behavior: any payment in excess of the minimum needed to keep a resource employed in its current use. So that usually goes towards the rich, and the rich become richer because of rents, and the poor don't really have access to rents. So government failure: clear benefits, hidden costs, unfunded liabilities, and chronic budget deficits, economic inefficiency, and debt crisis. So a lot of it has to do with misdirection of stabilization policy. So fiscal policy, there could be changes in tax rates and spending to change the business cycle. So spending more during recessions and cutting taxes during recessions to grow the economy, or in expansions they could they would raise taxes and cut spending to reduce government debt. So they do that during expansions because there's enough money coming in. Corporations to allow this. But during recessions, they need to lower taxes and raise spending to increase. They need to do this to help the economy. They usually increase debt during this period. And then monetary policy attempts to use changes in interest rates to regulate the economy. So in that case, they lower the interest rate to grow the economy through cheaper borrowing. And then they can raise the interest rate to shrink to reduce inflation through less money supply. Yeah. So less money supply can reduce inflation because prices will go up less because of less money in the economy. So that's usually what they do. So that's probably what the Bank of Canada is likely to do eventually, is raise interest rates, because we have a real inflation problem. Inflation is too high right now. So we're going to have to find a way to lower it. So then there's politicization of fiscal and monetary policy. So a big part of it is like liberals are more focused on spending, while conservatives are less focused on spending and more focused on tax cuts. So that's a big politicization thing, like with, so Harper, conservative, you cut corporate taxes from 21% to 15% from 2006 to 2015. And then like Trudeau, liberal, he raised government spending by over 500 by running 500 billion plus deficit during 2020. So yeah, like spending increases and then like tax cuts. So yeah, this is politicization, so liberal versus conservative. And then like Chrétien, liberal, raised taxes from 1993 to 2003. And yeah, so like that, to have budget surpluses. Yeah, so like that's politicization. And then central banks in charge of monetary policy. So the Bank of Canada has reduced interest rates from like has reduced interest rates because of the pandemic, and have bought government bonds to increase the money supply. So this is good for the economy. Increasing the money supply is good for our economy. It leads to growth. So yeah, those are good things that they've done. So that's a big part of, they use the interest rate and they use taxation and spending to change what the economy is doing. So like if they want to grow the economy or shrink the economy. So limited and bundled choice, bureaucracy and inefficiency, inefficient regulation and intervention, regulatory capture, deregulation as an alternative. So like they use deregulation to grow industries in the economy. So that's a tool that they use because it's easier to operate when it's decentralized. And then the government could invest into things that don't grow. So like, for example, the government could invest in things that don't help people or lead to more debt by the government. And then the government could do loan guarantees. Like in 2008, the US government guaranteed loans like a guaranteed mortgage loans, so that can be a problem because the government may take a loss on it and increase their debt even more. So socializing losses, privatizing gains, so they could be taking losses because they on, let's say, public transit, because they have to charge cheap rates for public transit so people can use the transit, and then they privatize gains through selling, let's say, Hydro One. So investors like me would make money on Hydro One while the government doesn't make money. So those are big problems. Like, so the government can go deeper into debt because of this and help less people. These are big problems. They can lead to a lot worse outcomes. And then corruption. So bribery happens. A lot of it's kickbacks, cash kickbacks, and government official demands a bribe to do something illegal. That happens a lot more than is reported. But Canada is a lot better than most countries, but it still happens. But like countries with less development are a lot worse. But corruption still happens everywhere, but less so in places like this compared to places like third world countries or developing countries. So, like you see here, percentage of households paying a bribe in the past year. So they use the government corruption barometer, and they show that the percent of households paying a bribe in the past years, Sierra Leone is over 80%. So like places like Sierra Leone and Kenya and Uganda are very high, like over 60% for each of them. So they're a lot more corrupt than, let's say, the United States. The United States is about just around before it's just below 10%. So there's still bribery that happens in the United States political system, but it's a lot less than somewhere like Sierra Leone. Like it still happens, but not not at a high rate. Like I think my belief is bribery will always happen, but it will happen less and less in countries that become more democratic and more developed. So like as so as a country becomes more developed and more democratic, there will be less bribery. So that's probably a good explanation for that. So like United States and Italy are very democratic and developed and highly developed. Colombia is getting better. Iraq is Iraq is officially democratic based on the U.S. intervention. Yeah, but it's not highly developed. So Mexico is developed. No, it's more developing, and it's democratic. But then South Africa is developing and democratic, but there's a lot of bribery that happens. India is developing and it's democratic, but like Uganda, Kenya, and Sierra Leone, I believe they are autocratic. So imperfect institutions, criticisms of public sector inefficiency, markets and government are both imperfect. Like they make mistakes. Yeah. So yeah, we went through that. We're gonna go through the next power. Actually, we'll do. Just gonna bring up the next thing. So we'll do a bucket. I'm just gonna bring this up. So which I'm gonna do a wait. So which one do you want to do this time? Gold Quest, Fishing Frenzy, Crypto Hack, Cafe, Tower Defense, Battle Royale, Factory Racing, or Classic? Tower Defense. Okay, we'll do that one. It's cool. It's a great one. Yeah, it's a really good one. So let's do damage. Yeah. What's really cool, it's like one of those tower defense games you play in a Dixon games. Yeah. So you can log in here. Okay, so whoever hasn't joined, you can still click on the link to still join at any time. Yeah, great job, Rambo. Great job, Amon. Great job, Brandon. Great job, everybody. Excellent work. Yeah, very proud of work for that one. So we'll do this one. Do this next presentation. So public choice theory is the economic analysis of government decision making, politics, and elections. So majority voting reveals preferences and determines what results can be inconsistent and imperfect. So it's inefficient if you pick no, it's inefficient if total benefits greater than total costs. So that makes sense because if you want, so like you should be voting yes if total benefits are greater than total costs because it's better for you because your net benefit is positive. Because total benefits minus total costs equals net benefit. So, and then inefficient yes vote is when total cost is greater than total benefits. So you should be voting no if total benefits are less than total costs. Government might fail to improve economic inefficiency of overproduction or underproduction of specific public goods. So if the yeah. So interest groups, those who have a strong preference for public good may band together. So public interest groups do that. So like for example, like the teacher unions would be one of those. Then like the teacher unions would be a good special interest group. There are many. So any like teacher unions, like healthcare unions, and unions that represent public good providers. Then like political log rolling, the trading of votes to secure favorable outcomes. So like lobbyists do that. So lobbyists convince government to support certain industries. So for example, like home builders, there's a lot of unions for that, a lot of lobbyists for that. And then paradox of voting, when society cannot rank its preferences consistently through paired choice majority voting. So preferences are determined through paired choice majority voting. Voting outcomes may depend on the order in which the votes are taken, median voter model. So like a lot of these people vote for a political party, let's say based on like what their focus is. Let's say national defense, the focus of voters. They're going to vote for the party that has, like, if that's the main focus of voters, they're going to vote for the party that has the best national defense policy. And then, like, if the main interest for voters is roads, they're going to vote for the party that has the best road policy. So, like, that's basically it. And then, so the problem is majority voting. Like, if you look at voting polls, they may not show they may not show what voters prefer. There might be a misalignment, like voter preferences of what they want might be different than the polling for each party. So this could lead to failures where they're where the money is not going towards the goods they need. Like there might not be enough on education funding or healthcare funding if uh, based on just looking at where voters are likely to vote for. Like let's say the voters are going to vote for, you know, like a demonstration. So let's say like Party A is leading in the polls. However, Party B has policies that meets more of the needs of the voters. Therefore, there will be a failure in this because voters will not get their needs met. Yeah. So that's kind of it. So yeah, like there's a lot of misalignment with what the voters are voting for and what and like meeting their needs. So our next activity to bring that up.
Words you'll hear thrown a lot in macroeconomic circles are monetary policy, and fiscal policy. And they're normally talked about in the context of ways to shift aggregate demand in one direction or another, and oftentimes to kind of stimulate aggregate demand, to shift it to the right. And what I want to do in this video is focus on what these two different tools are, who are the actors, and how do they go about actually shifting the aggregate demand curve. So monetary policy, this is literally deciding how much money to print. So it's literally printing money. Either deciding to print more of it or deciding to print less. Printing money. It tends to be done, in the United States especially, in most large countries, it's done by the central bank. It's done by the central bank, which is sometimes directly part of the government. Sometimes it's quasi-independent. In the U.S., it's a quasi. The U.S. central bank, which is the Federal Reserve, is quasi-independent. And in future videos, we'll talk more about the governance structure of the Federal Reserve. Most of the major appointees are made by the U.S. government. All of its excess profits goes back to the U.S. Treasury. So in that way, it's part of the U.S. government, but it's set up to be also has some influence from private industry. The member banks have a stake in what's going on. It often coordinates amongst member banks. So you have your Federal Reserve as a central bank in the United States. It's quasi-independent, but it's been given the right to print money. And I'll just draw it here as physical dollars, but most of the money that it's going to print actually is electronic money. And the way this affects the aggregate demand curve, the Federal Reserve doesn't just print money and go out and start buying things with that money. Well, it does buy things, but it doesn't go out and buy goods and services. What it does with this is it essentially lends it out. So it's essentially buying debt. So it buys debt. And if buying debt seems like a weird thing to say, buying debt is the same thing as lending money. Lending money. If I buy a treasury bond, so if I'm buying debt, I'm buying a treasury bond, it means I'm implicitly lending that money. If I buy the bond directly from the government, that means I'm lending that money to the U.S. government. If I directly buy a bond from a U.S. corporation, I'm essentially lending that money to the corporation. They're going to give me interest payments in the form of coupons, and then they're going to pay back that money at some future date. So this is essentially lending money. And what this does is it's increasing the supply of money that's out there to be lent. And so if we think of the market for money, so now we're going to think in microeconomic terms for the market for money. So the market for money, if this is the price of money, which is really just the interest rate, and curve, and let's say right over here, let's say this is short-term money, and we won't focus on the different durations and all of that, but let's say we're sitting right over here at a clearing interest rate of 5%. So it makes sense. So this is right here. This is our demand curve. So all of the people who will get more than 5% benefit out of the money, maybe they have an investment where they could get 10% on the money, or 8%, or 5.1%, they're all willing to borrow that money and then invest it in whatever they want to do. Or this might even be consumption. People who are say, hey, 5%, that's worth it for me to go out and buy that thing that makes me whatever happy. But from an investment point of view, it makes even more sense. If I'm going to get an 8% return on my money, that's my benefit, it makes sense for me to borrow it at 5%. It makes sense all the way up to 5.0001%, I'd actually borrow it. And so when the Federal Reserve, or any central bank, prints money and it buys debt, it goes out into debt markets and it usually buys the safest kind of debt, but that affects all of the debt markets. It goes out and buys debt market. They're essentially shifting the supply curve of money to the right. They shift the supply curve to the right. And so at any given interest rate, you could say that there is more money. And so the supply curve might look something like that. And this is interesting because assuming that demand has not shifted, what you now have is a different clearing price, a different equilibrium price for the money. Maybe this is now at 3%. This is now at 3%. And you also have more money being lent and borrowed. So if this was the old quantity of money that was lent and borrowed, let's say that this is, I'm just going to make up a number here. Let's say this is $100 billion in some time period, and now we're at $120 billion. $120 billion. So now by essentially printing money, buying debt, increasing the supply of money, two things happened. Interest rates went down, and so now you have all of these characters out here who before they weren't going to borrow money at 5% because whatever their benefit on that money was between 5% and 3%. Maybe it was 4% or 3.5%. It didn't make sense for them to borrow at 5% and invest it or only get a 4% return or a 3% return. But now that interest rates have gone down, now it does make sense for them to borrow the money, all the way down to someone who has some type of project or investment that has a 3% return. They also say, hey, I'm neutral. I could borrow at 3% and then I could invest. But definitely the person with 3.1% or 3.2%, if they have investments that give them that much, they would definitely want to borrow. And we could assume that all this incremental borrowing, so in this little example that I did right over here, all this incremental $20 billion of borrowing is going to be spent. People will borrow money not to just stuff it into their mattresses. They'll borrow that money to go invest it in some way, to spend it. And so what this will do, all of this will shift aggregate demand to the right. Right here we're talking in microeconomic terms, but then if we think about aggregate supply and demand, so this is aggregate. So this is, let me write aggregate. Aggregate right over here. This is price. This is real GDP. This is our aggregate demand. Aggregate demand. And then our short run aggregate supply might look something like this. Aggregate supply in the short run. And so if we're shifting aggregate demand to the right, where there's going to be more demand for goods and services, these people are going to borrow this money and spend it, you're going to essentially stimulate the economy. So if this shifts to the right, you have a situation where real GDP will go from this state to this state right over here. So it was expansionary. And obviously, if the Federal Reserve decides to print less money, or if they essentially soak up the money that's in the market by selling some of the debt that they own so that they're sucking dollars out of it, then the opposite effect would happen. Now, fiscal policy is essentially the government directly going out there and demanding goods and services from the economy. So this is essentially, you have the government. It has two sources of revenue that it can spend. It has money from taxes. It has tax revenue. And then it can go out and borrow money. And so it also has access to debt markets. And when a government borrows money, they're essentially issuing treasury bills. If you're talking about the U.S., treasury bills and treasury bonds. If you were to buy those from the U.S. government, you are essentially lending money to the government to finance their debt. And so they can take these two sources of money, and then if they decide to spend more, and let's say that they're going to hold taxes fixed, so they're not going to take out any demand from the economy, they might ratchet up debt and then ratchet up spending, and then this government is directly going out there and demanding more goods and services. So that could also shift the aggregate demand curve to the right. So these are two different levers, two different tools that have been used in governments all around the world to shift aggregate demand one way or another, or to an attempt to shift aggregate demand one way or the other. Monetary policy is more indirect. Printing money, using that to increase the supply of money that's out there to be lent, that lowers interest rates, and then because it lowers interest rates, more money, there's more willingness to borrow and invest that money. Fiscal policy, you're directly going out there and just buying more goods and services by usually ratcheting up your debt. Or fiscal policy could go the other way. If you're trying to restrain the economy, you could lower your debt, lower your spending, or you could do some other combination.
Okay, so yeah, that was a good video on how they use fiscal policy and monetary policy to help the economy. So, so what we'll do now is what I'll do. So I'll go through this example. So there's this thing called a liquidity trap that's the monetary policy, the interest rate won't work to. So reducing the interest rate will not grow the economy. So the government has to spend more and tax less in order to grow the economy. So this is an issue for economies that have debt problems because they cannot increase spending or decrease taxes because they need to pay off the debt. So the US had this problem because from 2009 to 2014, they reduced the interest rate and increased the money supply. However, this wasn't working. So they had to focus on government spending increases and reducing taxes to help the economy. So yeah, the government spending increase was the key to increasing output and employment. And then this happened in Canada too, because during that period, the Canadian government reduced the interest rate. However, that didn't work that much. They had to increase spending and reduce taxes. So liquidity traps can be a problem because the money supply, like if you increase the money supply, it's not going to help the economy. So what I'll do is, in this case, I'm going to make breakout rooms so what we're going to do in this breakout room is I'm going to ask you the question, how would you how would you grow your economy if you were in a recession and you how would you grow your economy if you're in a recession and you had the ability to change the interest rate, money supply, government spending, and taxation? So that's gonna be my question. So I'm gonna put you in breakout rooms and you're gonna answer it as a group, and we'll do that until the test starts. So I'll put everybody into breakout rooms and I'll send you a message with a second. So I'll broadcast a message. I'll give you a few minutes to do that and then I'll let you share. So we're just so I think we have enough people back right now. So I'm going to ask you, when you were in your breakout rooms, how would you grow your economy if you were in a recession and you had the ability to change the interest rate, money supply, government spending, and taxation? So anyone want to volunteer an answer? Yes, yeah, exactly. That's a good answer. Yeah. So you can do that. What else can you do? Yeah, good answer. Yeah, lower interest rates, corporate tax 10%, and following the deregulation and overall spending. That's great. Yeah, that's good. So yeah, deregulation is a good strategy because that can increase. Like, I know Elon Musk talks about how having little regulation is good for his business because he has a lot more freedom. But some regulation is good because you need regulation for, like, let's say the FDA. So like the vaccine has to be regulated by the FDA. That's good because that makes sure that the vaccine is safe. And then investing heavily in research and development so that new products and services are ready to launch, economy begins to grow again. That's a great idea. Yeah. So like tax credits. So there's this tax credit. I'll tell you, it's the shred tax credit. It's like so any like science, research and development, you can claim shred tax credits, research and development spending. So you could literally become an accountant. Like if you wanted to become like a, a, a private accountant for businesses, you can literally focus on shred. So like claiming their research and development spending, you can literally start up your own business based on that. So yeah, so competitors, yeah, like R&D spending, the government promotes it through the shred tax credit. And also there's a lot of grants for research and development. So that's good, Hamza. That's great. Yeah. Anything else, anybody? Like how can you, yeah, reducing taxes is a good one. That's great. Nolan had a great idea. Erica had a great idea. Yeah, reducing taxes, that's all great. Like the government does all of this kind of stuff when they want to, improve the economy. So does anyone else have any other ideas on how to improve the economy in a recession? Okay, so I'm just gonna, yeah, stimulus packages, that's good. Yeah, like I, I liked how you I liked how you put the disclaimer if done properly, because that's correct. Like there's a lot of, if it's not done properly, then it won't work. So that's great. I liked how you brought that up. Then so anybody else wanna volunteer any answers? So like some of the answers that I'll show is, so like the money supply increasing, so interest rates decrease, and then like currency depreciation can happen with a reduced interest rate. So if like the interest rate goes down, interest rate goes down, currency depreciates, and then exports increase. So this can grow the economy because exports increase GDP. So like that can be a good way. Then so the government can do that. That's another way the government can grow the economy. So then this I wrote this blog when I was in university. I go through a lot of the I go through a lot of it's economic, most of it's economic, and like it's a lot of macro and microeconomics. So like working governments, one article that I wrote. So the governments can increase economic growth through strong law enforcement and improved courts, improved military, and then efficient loan markets as well. So like providing loans to people can increase can grow the economy. Efficient trade legislation, so free trade can grow the economy. And then providing doing sales taxes instead of other taxes would be most efficient. So just having a sales tax instead of having corporate taxes and income taxes, that would make the economy work better. So those are good ideas here for how to grow the economy. And then so yeah, there's a lot of like in this blog, there's a lot of these ideas on how to grow the economy based on a lot of macro microeconomics and then other courses as well. So good question. It can. So that's a yes and a no. So so the war in Afghanistan and Iraq from 2001 like to 2000 to however long it has been, the US economy has grown like during the Bush period, like around like 2001 to 2007, because a lot of companies in the US were getting government contracts for the war. So like Halliburton was getting a lot of government contracts for weapons for the war. And then also Lockheed Martin for a lot of airplanes for the war, and a lot of like Lockheed Martin and a lot of other companies that are focused on providing war materials. So like I'd recommend watching a movie called War Dogs. It's with Jonah Hill and Miles Teller, but it's a really good movie because it's a true story. It's completely true. So these uh these weapons contractors are making millions and millions of dollars just selling ammo to the US government. So like companies like that were making millions on the war, so they were doing very well. It was good for the economy for them. But the problem is the flip side of that is that the destruction in Afghanistan and Iraq is bad for their economies, because now Afghanistan, since they left Afghanistan, the Afghanistan is the third world country. It's got extreme poverty. So the war was good for the US because all these companies got contracts for the war, while Afghanistan was just destroyed. So like it's good for the US for in war, but it's bad for Afghanistan and Iraq because those countries just were in complete destruction basically. So yeah, that's a good question, Ethan, because it has like it's a yes and a no. So yes for the US, no for Afghanistan and Iraq. So good question, Ethan. That was a great question. So what I'm gonna do now is I'm gonna make the test open. I'll open it up and you'll have the rest of the period. I'm gonna close out the Zoom session, but I'll be available on email. Just gonna make it available and I'll show you where it is. Okay. Available. So what I'll do is I'm just gonna 1 second. So yeah, here it is. So go under assignments here, everybody. So go under assignments. So I'll go to student preview. So go to assignments, and then term test 1 will be right here. And then so download the document and then fill it out, and you can answer it however you want. If you want to put the letter right next to the question, or make your own document with all the letters, or like bold the letter that you want to pick, or do whatever. Just show me which letter you want to pick for each question. And then you submit it to the Dropbox. Or my email, whatever is more comfortable. But so yeah, that's just gonna share this. So here it is. So these are the questions. So just write down what the letter is. So there's about 31 questions. So does anyone else have any questions for today? Like before you do the tests? Do you have any questions? So the Dropbox is the Dropbox. I'll share my screen again. Okay, sure. So just submit it, everybody. You go write submission or browse local files. So like you go to browse local files and then you pick the file, like your answers, or you can write submission. Like you literally do like 1A, 2B, 3C, 4D, and 5D, let's say, and then just you could write your submission in here if you want. And then you press submit here. Yeah. Or you can just attach your document on browse local files. Yeah, if you want to write in a Word document, it's up to you. So that's how you do it. No problem. Does anyone else have any other questions? Because you can, once I close the meet, you can reach me over WhatsApp or over Niagara College email. So my Niagara College email is this, if you have any questions during the test. And then my WhatsApp is, so you can reach me on those. Yeah, so you can reach me on those if you have any questions, but does anyone else have any other questions? Okay, so if you have any questions, just WhatsApp me or email me at Niagara College. And then, yeah, I'll give you the rest of the time to do the test, but I'll close the meet. No more questions? Okay, great job today, everybody, and good luck on the tests, and just, yes, submit it when you're done, okay? Thanks, everybody. Yeah, great job, everybody. Great job today. Thanks for all your help and great questions, great participation, and excellent class. Yeah, good luck, everybody. Yeah, you too, everybody.